Now, on our larger estate, we've got to keep going. We have more things to deal with. On the larger estate, the next thing we're going to look at is life insurance. The death benefit of life insurance is includable in the calculation of federal estate taxes. It's includable if the insured is either the owner or the beneficiary. Now, we just can't, in most policies when they're written, the designation of owner or beneficiary are probably going to be left untouched. The only way you really can tell this is usually looking at the copy of the application that's in the back of the policy. But if there's nothing there, if it's left blank, then these designations are filled in with the insured. And that means the death benefit, when the estate holder dies, if he's the insured, will be included in his estate. If we make these three things, insured, owner, and beneficiary, different, then we're going to have a gift tax issue when the estate holder dies, because the death benefit is going to be considered to have been given by the owner to the beneficiaries, and that'll be a gift subject to gift taxes. One of the best options available is to set up what's called an irrevocable insurance trust, where we can make the owner and beneficiary of the insurance to be a trust, and it's an irrevocable trust. The estate holder and their spouse can't be the trustees of this, but usually some combination of adult children would be our designated trustees. They can manage these assets, and that avoids estate and gift taxes on those death proceeds. In our current scenario, I've got a slide up here to show what happens when we pull those death benefits out of the calculation, and we're going to have those transferred to the children outside of these estates. It reduces the federal estate taxes even further. Now we have federal estate taxes under a couple of $1 million. Now we want to go one more step. At this particular point, we've probably implemented as much as we can in order to reduce the estate taxes by these documents at the estate holder's death. The next step in proper planning is we've gotten this estate as efficient as possible at the estate holder's death and the spouse's death. We now want to maintain that efficiency. One of the problems you have in estate planning is you get the taxes reduced, and with appreciation, particularly on business assets and investment assets, they grow back into an estate tax problem. And so we're looking for ways constantly to cap that growth, to shift that growth somewhere else. We can gift away assets, and we use freezing of the growth, and we'll talk about that here in just a second. But basically, we're going to talk about gifting and freezing taxable equity. We're going to talk about asset protection, and we're going to talk about contracted equity, looking for ways to transfer equity at death that still accomplishes some of our intentions. Going back to gift taxes, we can gift $12,000, $13,000 now. It's been adjusted per year, per donor, or per donee. That means that a parent could give $13,000 to each one of 4 children. They can do that per year. They could gift another $13,000 to a spouse of one of the children. The other parent can do the same thing. So when we add those multiples up, we can see that it can be quite a bit of money. One caution is that you can get into a lot of problems when you include in-laws. We love in-laws, but we don't necessarily want to give them a piece of the family business, because as you all know, marriages come and marriages go. And when the business is involved in a divorce, it can really wreak havoc on the management and the profitability of that particular business. So that's one of the things we want to do, maybe do gifting just for our children. And then we can do those amounts, $26,000 essentially, to each one of 4 children, which is $104,000 that we can transfer from the parents to the children each year. Now the problem is that cash is the good stuff. That's always the hard stuff to find. What we'd like to do is find ways of transferring these assets and divide up that going business concern. We want to keep the cash, and the problem is we've got a multi-million-dollar business, and we'd like to find a way to gift it away and still be able to retain the cash in its income. One of those techniques is freezing. It's called freezing the estate equity. And what we do here, I've got a graph up here that kind of shows how we do this. We would a lot of times set up a business entity, and what we're going to try to do is find a way to give shares to the parents that do not appreciate, that don't grow, but they do have income to them, much like preferred stock. And then we're going to look for a way to transfer to children what we would probably call common stock, stock that has a growth factor to it, but doesn't necessarily have a lot of income. A lot of times parents want to control the business, and there's been quite a bit of regulation on how much control. They really have to kind of equalize the control. But the process, if we give all of the growth to the children and keep the income, the graph here, the red line, shows how even though the asset itself, the business, keeps growing, the yellow line shows what the parent's taxable equity is, and it shows that the difference, the growth between those two, accrues to the children, so when the parents die, it doesn't get taxed. In doing this, we tend to favor limited liability companies over corporations and family limited partnerships, just because there's an asset protection feature to this. The limited partnership and limited liability company not only allow us income tax similar to the individual, we avoid corporate income tax, and it allows us multiple types of shares, shares that have income versus shares that have growth, but it also is going to protect the assets from outside creditors. Particularly with the limited liability company, we can manage the assets, but we can avoid a particular creditor of a particular shareholder, such as one of the children, say in a divorce, or if they're in some sort of personal injury type situation, or a judgment creditor. The family shares in the family business are beyond lien or levy by outside creditors. And that's a tremendous protection to the family in being able to share this with family members. When we add a freeze like this to this particular estate, what we end up with is we reduce the federal estate taxes even further. But we're also going to be somewhat assured if we put all these assets into a projection, and in the number crunching and the estate tax calculations that we do at Foster Estate Planning, we do a projection, usually a 10-year projection, to see where these assets are headed if we include the appreciation and the value of the assets for a 10-year period. And it can have a tremendous difference in the amount of savings that we're going to have to the estate. In our slide up here, the red box, we still have a little bit of tax left. We still have about $1 million left, but we're whittling down the amount of loss through death taxes and administration of the estate.